All right. Welcome to today's market cap. This is Christian from Tribeca Trade Group, and what a humongous day to the downside for the market. Where to start? Well, I could talk about today's volume, and then we'll talk about today's moves. But if I want to look at the overall volume here, just heavy volume. Look at the SPYs traded 292 million shares today. That's 3.2 times average the 30-day average volume. You have EEM trading almost the same, about 3 times. You have VXX, and this is where I want to concentrate a little bit today. And so we've got just a huge move down here. We stopped. The market's got a little bit of a bounce, but um, that bounce was very short lived. So really nasty price action. And we talked about how in this weekend's video that you really can't discount. When you have a decent move that we had on Friday, of where things are going to find support. You just don't know. You really don't. You could look at a couple levels, and if they don't hold, then you basically want to get out of the way. And that's kind of what we got today. So I think a lot of people, I had CNBC on today. Everybody's looking for a reason. People think that there was a flash crash today. I think it's a culmination, and it really doesn't matter the why, but I'll give you my 2 cents, is that there's a few things that I think that the market just did not like, and a few things that got a little bit dangerous in the market. So whether it started last week with the German Bund, with overall interest rates moving higher, that caused some disturbance in the marketplace. We talked about the velocity of the move was pretty quick in interest rates. That was unsettling. You also had the FOMC last week that said that they have their eye on inflation. They're going to be watching that. There could have 4 interest rate hikes this year. So these are a couple unsettling things. I think the ECB was also out last week talking about when they're going to raise interest rates too. So these things just kind of set off a little bit of unsettling action. And then you had a couple things like today where it looked like the price action was trying to find a footing today. We actually had a little bit of a bounce at one point. I think the Qs were up at one point, maybe 35, 40 basis points around 10 o'clock, and it looked like it was the usual buy the dip mentality. And that did not work out too well. And so that it becomes the other thing is I think everybody has gotten to being very complacent about any market volatility, that it gets bought up so quickly. And I think there was some revealing data points that came out a little while ago, one of which I could share to you, but another one I think from TD Ameritrade, when they reported earnings, they were saying that cash balances are like the lowest that they've seen in years. So perhaps there wasn't the amount of cash on the sidelines for people to really come back into the marketplace. There's no buyers left. So you don't have that underlying bid to the market anymore. And I've certainly seen that in ETF fund flows. I mean, there's been ETF fund flows just about every week. Maybe 1 week I think we saw after quadruple witching back in December, where there wasn't a large amount of equity inflows. So it's been running very hot in terms of money that's being added. Another area that cause for concern, I would say, is that there are a lot of funds that have shorted volatility, have made a lot of money over it, and they've been doing it over and over again. And I noticed this last week. If you look at the fund flow sheet that I have, and you could see some of the biggest inflows last week were this people doing the same thing. This XIV is inverse the VIX, $415 million of inflows last week. Also, SVXY, which is also inverse the VIX, profits when volatility goes down. So we had this little spike up last week, and people did the same drill that they've been doing, is they short volatility. So when this starts happening, when it starts getting out of reach, and people have to cover those volatility shorts, you could have a massive move. And this has gotten to be just like the buy the dip mentality. Has gotten to be a very overcrowded trade. And now I don't know if that's the reason. Clearly, when even the market was started just to kind of retrace itself from today's dip, once this hit 20 today, it was kind of like a decent head scratcher. It's like, why is volatility still cranking up here? And we saw this just in a matter, and it started to really happen very quickly. From around 12 o'clock to basically 1 o'clock in an hour, we went from a 20 to a 23 in the VIX, which is a large move considering that we haven't had that type of move before. So I think this is going down as one of the biggest one-day increases in volatility without, and I would say without a major event. Normally when this happens, we looked while the market, just after the market closed, and usually when you have a big spike up in volatility, it's because there was some big China fears that were happening. There was the flash crash. There was, just a few different things like event-driven things. To not really have anything that caused us to go all the way up to, a 38, 39 in the VIX from a 15 today, or 16, 17. That's pretty dramatic, and it just tells you how quickly things can come undone. If you went out for like a late lunch or something like that, and you come back, and that's how quickly that this market can move nowadays if everybody's on one side of the fence. So that's the wrap up for today. The volatility or the option activity, which I'm not even going to go over. It really didn't give us any major signs. I mean, there was the normal call buying that we saw in the first hour of the day that we've been seeing, the normal buy the dip mentality. And it just seemed to kind of get away from people. Maybe there just wasn't enough money to kind of support that buy the dip mentality and to push volatility back down, and for equity prices to regain some levels. I think maybe the tank is dry in terms of how much money. The pain trade, I said this earlier, the pain trade is when this volatility keeps going up. You've got, and I don't know the exact facts, but I would imagine there's some big institutions that are going to get blown up because of today's price action in the VIX. There's just too many that have been doing that trade over and over. And again, you could see those flows. I mean, this is a huge amount of money that went in just last week. I mean, this is almost $1 billion. Another $1 billion trying to short volatility that went into the market last week. Not Friday, but I think it was around like Tuesday or Wednesday last week. So that's dangerous when it doesn't work, and when the status quo doesn't keep happening with the buy the dip mentality. It could be troublesome, and I think that's more of the reason rather than like a flash crash. You got to remember, people are going to talk, oh, it's the algos and so forth, or it's the ETFs. It's the programs. It's the people who are running the programs, who set the programs. I could tell you right now, some of the trading that, one of the portfolios that I run is more of a quant-based portfolio, where if it starts to break moving averages, I sell. And I did that today in one of my portfolios. I was liquidating as things were breaking my pre-programmed support levels. So if a lot of big funds are doing the same thing, you're going to have issues. When you don't break any major support, you don't need to sell. But when people are like me, who have quant funds and that are pre-programmed at levels, once they break those levels, just like we saw. I mean, you can go back to the S&P, and then I'll leave it here for the day. But if we look at, it doesn't matter, SPY or S&P futures, it doesn't really matter what instrument you look at. But so I'm bringing up the S&P chart here. Well, it's taking a little bit because my computer's slow after all today's market activity. But once we broke this 50-day moving average, there was a little bit of a pause. And then once we decided that this was going to break, that's really where we accelerated to the downside. I think that was 22.17. And I'll try to bring this up just to see where this was on the 5-minute chart. Sorry, that must have been the wrong level. 27.17 was it? But I think we hit this area here. This was the 50-day moving average. We bounced, and that was it. And then we really accelerated to the downside. Notice if you just use the moving averages, how great a guide they are, because we clipped the 20-day moving average here to the upside, bounced, failed, tried to bounce here, failed, tried to bounce here, failed. Then we had this big move. We came right back up to the 20 again and failed again. So, this is just very, very technical trading. When you see something like that, we saw that last week. We saw that on Friday as well. So it just seems like a lot of selling that may be pre-programmed, into some models, like model selling. All right, that is it for today's recap. We'll see what we get in the overnight markets with the averages finishing on the lows. I think, unfortunately, what I did in my portfolio was I did some liquidation today, because just like on Friday when we finish on the lows, will we be due for an oversold bounce? Maybe tomorrow, sure. But I'll be ready, and I'll have cash ready to quickly buy the dip if that happens. All right, guys, thanks for watching, and have a great night.